Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. I've actually been following him on Twitter for years. He's a really interesting guy. His analysis, you can see him on business television almost every day. He's on Fox Business, CNBC, elsewhere. Very good analysis on Bitcoin, commodities, stock options. He's a veteran futures and options trader, also managing director at TJM Institutional Services. And he co-hosts the new Futures Edge podcast with his business partner, Bob Iaccino. If I'm pronouncing that correctly, I've had a phone conversation with Bob once or twice in the last couple of months. Jim Iuorio, thank you for joining me.
You nailed both our names, and neither one of our names is particularly easy, and you nailed them both. So we're getting off to a good starter. Thank you for having me, Jason.
I've worked at Italian restaurants for years as my college jobs, and actually, I really want to get your insights because you do own for our listeners out there, Jim owns a top burger restaurant in the Chicago area. It's famous. So we'll talk about the restaurant industry and all the stagflation, shrinkflation, input costs later in the interview. But first, let's talk about your experience as a futures and options trader. Now, you've lived in Chicago and worked there for many, many years. I want to get your thoughts on how the day trading options industry has changed over the last couple decades with high frequency trading algorithms, retail traders. Do you think that this is causing instability in markets with all these high frequency trading algorithms and how retail traders are now trading stock options like crazy? And even now, these 0-day options, what are those?
So I'll go backwards then. I'll start with the 0 days to expiration options. They've been launched by several different exchanges to kind of capture the day trader, the people who don't go home with a position. And each day, they expire at the end of the day. A lot of old guys like me who've been around a long time, they see something that's new and something that's in the retail space, and they act like, it's the end of the world. I don't think I agree with that. I like to see a new crop of traders learn how to use options, because options get a bad rap sometimes. You can, if you sell naked options, obviously you're giving yourself unlimited exposure, and it's a terrible thing to do. But if you buy call spreads, put spreads, or buy options, you're defining your risk. So to me, I worry less about these big, everyone heading for the exits at the same time events because of the explosion in the 0 day stop to expiration options. I worry less about it than I did if people were just trading the underlying. And yes, I know that it is a highly leveraged position when you use options, but it also, that's one of the reasons I trade options, and I use call spreads and put spreads and flies to replicate the position I want, because if it begins to go against me, I want to know exactly how I'm going to lose, and I don't want to be heading for an exit at the same time 10,000 other people are at the same time. So I don't think the 0 days to expiration things are that big a deal. Now let's go to, you said that the algos. So the algos started, and Michael Lewis wrote a book on this. What was his book called? Do you remember? Flash Boys, right? Where he was kind of dogging the algo traders. Algo traders have saved retail traders and even investors a lot of money, because they do have a market making function across assets. Like, for instance, let's go to 50 years ago. Like, if you were going to, buy a GM, you go to the market, there's one guy pricing GM or five guys pricing GM, and you have to pay the offer, sell the bid, and the spreads are very wide. Once you add the high frequency people into it, they have these very, very complex systems that are across assets, that are correlated assets. Like, let's say some guys trade Apple and Amazon and Google all at the same time, and they make markets in those, but they base them and they can tighten them based on the markets that are being made in the other things too. Does that make sense, Jason, or no?
So for our listeners out there, you're explaining how the old school market makers used to do things. So the old school market makers, there would be a market maker who used to make enormous profits. Market making, a couple brokerages used to do it, or market makers and broker dealers, like even Bernie Madoff before he was running the Ponzi scheme, right? He was a market maker.
Right.
That's the only example that comes off the top of my head. Funny, right?
Yes. The greatest criminal ever, which I'm sure there's many market makers who aren't. I'm just kidding. Most market makers are not criminals. But it adds competition. So the high frequency traders and the algos added competition to the market making game. And it's all part of when we went to computerization. Remember, when you've been doing it for 37 years, when I started, there was no trading computer. When you wanted to buy something, you'd call someone, the order would go down to a trading floor where there was 5 specialists who would make a market for you. And I think bringing the high frequency traders into it and the algos into it has been good for spreads, probably made people money. Does it open up the door to, when you take the human element out of it, if we start breaking out of certain areas and they go from being a market making strategy to all of a sudden chasing it and buying it as it's high and selling it was low? Yeah, I think we saw that in the flash crash when was the flash crash? Back in 2010. And we saw that. We saw that high frequency traders all of a sudden chase a market down and crack at 10%. Do we run the risk of that? Yes. Is it on balance, good and bad? Nothing is, it's like Thomas Sowell always says, there are no solutions, there are only trade-offs. So the trade-off we get is tighter spreads when we go in and out. And the problem we get is that maybe down the road, there is some time where it exacerbates a move because of a weird quirk in the algorithm.
Okay, so the point you're trying to make for our listeners out there, so I could simplify this a little bit, how you're saying it's good for retail traders. Some of my listeners might not remember this if you're a younger millennial, but when I was a teenager, I think it was over $50 per stock trade. And you used to have to call your broker. Maybe there was a website, but the broker still had to clear the trade. And they were charging over $50 per stock trade. And now, because of the new technology that Jim has described, with more liquid trading and more market makers available with high frequency trading algorithm, those costs have gone from over $50 a trade. And I'm sure there used to be a lot higher, but only like 15 or 20 years ago, they were still over $50 a trade. Down, it's close to zero for most of these online brokerages. I mean, like Robinhood, I think I trade at E-Trade and my commissions are close to zero. So a lot of these other online brokerages, the costs have been down, and that benefits retail investors in the long run.
Yeah, and that's only half of what I was talking about, because the other half I was talking about the bid-ask spread when you ask for a market. If you were trading GM 50 years ago, it'd be like $30 and a quarter offered at $33. It'd be a big wide spread. So the market maker, if they bought the bid or sold the offer, they'd be doing fine, but you have to pay a lot to get in. And now, because of all the different participants globally making markets in the same thing, those spreads, and now we trade in tenths. We used to trade in 16ths or 30 seconds. I don't know, it was so convoluted. It was crazy. But now we trade in tenths and hundreds in these stocks, and it's much cheaper to get in and out because of that, and because of the cost, the commission costs.
But there is still the risk of someone like nefarious, like Ken Griffin, as we saw in the movie, Dumb Money. And I'm sure like you've dealt with Ken because he was in Chicago, and I guess he moved to Miami during the pandemic. But it was exposed during the movie Dumb Money that he did a bunch of nefarious stuff. So he was buying the data from Robinhood app, and he was trading ahead. He was front running it. And then he was trying to put pressure on the Robinhood people to block the GameStop trades.
Yeah. And I remember when that happened, and that to me was appalling, that when the Robinhood thing and the GameStop traded, and all of a sudden the big hedge funds who were supposed to be in control of everything, and they were getting run over by the retail guy. I actually thought it was kind of, funny is the wrong word, but it's nice to see, David drop Goliath every once in a while, and to see those guys panic and say, oh shit, what's going on? These guys are beating us. And then all of a sudden them trying to change the rules, I thought was rather appalling. But yes, to your point, it does open doors for different sort of nefarious activity. But I will say that there's never been a time in our market history, whether it be any market, that there hasn't been a good amount of nefarious and sinister characters who are, trying to game the system for themselves. So I think that that's just a cost of doing business that we should always be vigilant against, by the way. We should always be trying to expose them, and people who trade on insider information and people who try to rig the system. But, things like, in Flash Boys, these guys who would build out data centers as close as they could to exchanges and trading rooms as close as they could, because they could see an order coming into one exchange and then race it to the other exchange. Do you know what I'm talking about? Did you read the book at all? It was fabulous.
Yes. So yeah. They were spending billions of dollars building out the internet connectivity speed. So there was a race to go from the Chicago Board of Trade or Chicago Mercantile Exchange to New York City or New Jersey area for the hedge fund high frequency trading algorithm. So the book describes like all the investments into what the cables, the high speed internet access cables.
Yeah, it's crazy. And like you'd put in an order to buy 100 shares of Apple, and it would hit the NASDAQ, and maybe there was only 30 offered there, so it had to be routed to another exchange, almost instantaneously. But then the Flash Boys guys would see it hit the NASDAQ and then beat it to the other exchange, buy the offer, and sell it to you a couple ticks higher. Now that's bad. I mean, I understood that is, but 40 years ago when I started on the exchange, you literally would hire a runner who was physically faster than the other runners to run your order to the pit to get it there quicker. Like, I know it sounds like caveman world to you, and it is when I think about it, but it's the same thing, right? So that one of the reasons, I was good at the beginning. I could run a 4.5 40-yard dash. I could head to the pit quicker than anybody else. And it just, all it did was change it to doing it digitally. So it's the same thing, different year on it.
Are these institutional investors, pension funds, are they taking advantage of like these 0-day options? Are they trying to use these things as income products to collect options premium? So are we seeing a lot of that now?
I don't think so. And again, by the way, this is just got outside of I don't have as many pension funds as clients as I used to in the past. I had very few. I don't think so. My understanding, and again, this is not something that I speak like an expert on, that the 0-day stock expiration are basically just a relationship between the day traders and the companies who are making the markets in those, which I think are the brokerage houses who are, taking the commissions on those or taking the spread on those. But I don't think it's being used institutionally other than the market making side, other than the marketing fuel.
So I want to transition now to like global macro and inflation. You've been around markets for a very long time. You've seen the stock market rise enormously, real estate markets go up. Do you think in the current system we have, our politicians and bureaucrats, central bankers, are they going to allow deflation for a prolonged period of time?
I don't believe so. I think realistically, central bankers are terrified of deflation, and they'll do anything they can to avoid that. And I think we're seeing, some of the ramifications of those decisions right now. I think so. Here's something that's fun. We all look at Japan, and we know that Japan was in somewhat of a disinflationary / deflationary quagmire for the last 20 years. We all know, as a group of financial analysts, that the second supply chains locked up, a light bulb went off in their head and they said, oh, great, we have the opportunity to cause a bunch of inflation. If we hit the gas pedal now on accommodation, negative interest rates, just flood the system with yen, and we'll finally break ourselves out of this deflationary quagmire we've been in for so many years. Now, we know that they did that on purpose. Now, then we changed the lens to the United States, who was dealing with not the same thing, it was different. But our central bankers were very upset that they couldn't get the inflation they wanted. This is probably for 10 years before the beginning of 2020. They said it. They said it 100 different times. They'd come on air. I always likened it to a guy who's at the barbecue trying to start the charcoals and can't get them started, and finally just drops the whole bottle of lighter fluid on it and throws the match in. I used to say that about our central bank, about the Federal Reserve, prior to 2020. So when 2020 happened, supply chains locked up. There was on the supply side of the equation, there was a problem. I don't think it is outrageous to suggest that they used that as an opportunity to finally get the inflation they wanted. Because remember, without the inflation, there was so much indebtedness, particularly in the government sector. Let's just say like the 5 states, the murderer's row of 5 states would be Illinois, California, Connecticut, New Jersey, New York. They were all so indebted that there was no possible way they could pay their debts unless there was a major inflation event. Guess what? There comes a major inflation event. So the moral of the story I'm trying to say is that central bankers, when I heard Jay Powell say that the inflation is transitory, I viewed it a lot differently than everyone else. The market and everyone thought he was saying, don't worry about it, it's transitory. I think he was saying, I'm personally worried about that it might be transitory, and I have to keep rates ultra low and keep buying bonds for the next 6 months to ensure that it isn't. Because the only way some of these states survive is with rampant inflation, and that's what we have.
Well, there was even worse than that during 2020, during the pandemic. I mean, the Federal Reserve Bank was buying municipal debt. I mean, they were changing the laws. They were buying corporate debt, or at least saying they were going to buy corporate debt. I think they bought some, but nowhere near the amount that they were saying they were going to buy, and that restarted credit markets. And then they bought a bunch of municipal debt. Even worse than that, you had the Fed governors that came out. They were front running all those trades on the bond purchases.
When we found that out, and I want to pat all of us on the back on financial Twitter, when it came out that Richard Corrida, Jay Powell, those guys were literally putting on futures trades the moments before they were giving a big Fed announcement that was going to move markets, and it was legal for them to do so, it was absolutely appalling. For personal gain like that, like we're looking to these guys, and that's I guess maybe one of the reasons why I'm such a big Fed basher all the time. Every time we've given them enough rope, they've hung us with it. And all of a sudden, someone's on the opposite side of that trade because Jay Powell knows he's going to cut rates. That to me was absolutely appalling. But do I think they generally have the best interests in mind of the country? I'd say the answer to that is a qualified yes, but their best interests don't align with your and my best interests. They need inflation at a steady rate because it pulls forward consumption, it pulls forward borrowing to consume, and they know that the most perfect and dynamic economy would be with a 1.5% to 2.5% inflation rate. Well, they don't have any way to pinpoint what the actual inflation rate is. They've absolutely crushed the buying power of the dollar over the last 50 years in the name of trying to achieve this 2% rate, and they don't know how to measure it correctly. Measure the dollar against what it can buy, not against other currencies, particularly when other currencies are doing the same crap that we are.
And I sent you that chart from the St. Louis Fed. People haven't seen. I think it's the wholesale food index since 1950. So that's a long-term charts right there on the St. Louis Fed website for food prices. That chart's parabolic over since 1950.
No doubt about it. And that's what I'm trying to say is that, in Carol Roth's book, You Will Own Nothing, she actually takes an excerpt of something that I said about, which I was very proud of because Carol Roth's an excellent writer. When I was reading the book, I love seeing my name in it. And I don't mind giving myself a pat on the back on occasion, whatever. The point she said was that what I said was that we measure the dollar poorly. You measure the dollar. Only thing that matters is what that dollar can buy. And we're not going to go out and buy euros and yen with it. We're going out and buy groceries with it. Chicken is up 40% in 4 years' time. Eggs are up 70% in 4 years' time. Beef 30. These things have all gone through the roof. And the White House still comes out and says we've tamed inflation. Yeah, well, 70% of the people out there don't have enough money to buy stuff. So I hope they're happy.
Well, I would say the economy is bifurcated. So you have the stock market looking nice, the government economic data looking okay. The narrative is that the consumer price index over the last 6 to 8 months, it's trending downward, although there was the spike. But like you said, in reality, for most Americans, the real economy is bifurcated. So there's haves and have-nots. I mean, there's a bunch of people that don't own a lot of stocks, don't own a lot of real estate, are not benefiting from the asset price inflation that has been the policy goal for decades.
No, I think there's zero question about it. And when I break it down, because I think by my thumbnail calculation, so the amount of money that was created from 2011 to 2020 in response to, I'm talking about M2 money supply, it went through the roof to handle the Great Recession, the fall of the Great Recession. Even if we stayed on that upward slope of M2 money supply, right now where we are, and I want to explain this so you understand what I'm talking about. Then we accelerated in 2020. We accelerated huge in 2020. Even if we stayed on the ridiculously high slope from 11 to 2020, we'd still be like $2.5 trillion below where we actually are. So in my mind, there's $2.5 trillion extra dollars that are floating around in the system. And guess where they ended up? They ended up at the top 30%, not the bottom 70%. That's not the way money works. Money goes to the rich people. And even in 2020 and 2021, when they come out with these asinine give everybody $1,500 thing, I'd argue with people and I'd give them speeches and say, yeah, you're getting $1,500. My assets are about to go up $200,000 each time they institute one of these policies. So all this is you're going to spend your $1,500 on 5 dinners with your friends, and my assets are going to go through the roof. This was one of the biggest wealth transfers in history that we saw in the COVID mitigation strategy and the money printing that's happened. It's appalling. And when you look, and that's why you mentioned the word bifurcation, which is a beautiful and brilliant way to describe this. That's what's happening. 70% of the people are in a recession, in a damn deep recession. 30% of the people have more money than they know what to do with. And they're the ones that are obfuscating some of the economic data because they're still spending and they see the government spending like drunken sailors, and then they do the same thing. Restaurants, high-end restaurants are still relatively crowded in wealthy areas. Like the northwest suburbs of Palatine, where I am, the restaurants are always pretty crowded. I imagine if you go to some rural areas where people didn't have money, the restaurants are not crowded at all because people don't have money. The rich got richer and the poor got poorer.
Amen. It's so same thing with luxury goods, luxury travel, you're seeing that. And then meanwhile, people who are upper middle class, they're trading down. So the Walmart CEO, Walmart CFO are saying upper middle class people, they're seeing people with higher incomes start to shop at Walmart and some of those discount stores and the wholesale stores. So I would say it's actually worse than the 70%, 30%. I'd say it's closer to 90%, 10%. It's worse than the Pareto principle. And for fans of the Austrian School of Economics, I would say it's basically the Cantillon effect here. The Fed was openly promoting this since the Greenspan Fed decades ago. I mean, they were writing op-eds about the wealth effect, that if your stock prices, your stock portfolio, your home price went up, that the consumer would go out and spend, but that doesn't benefit everyone.
Now you get an amen. Absolutely. And I was trying to be nice with 30-70. You're probably closer to right with 90-10. Yeah, the one thing the Fed is excellent at is making the rich richer and making the dollars that the poor people hold in their pocket without the benefit of owning stocks and assets and real estate and bonds, make those worth less money. So again, we're on an awful path. We're particularly for the poor.
So you think then that inflation hedges are long-term? Yes, some of these commodities are in a bear market, although I would say soft commodities are definitely not a bear market. I mean, look at cocoa prices, aren't they parabolic? But a lot of these other commodities are in a bear market. You would suspect then that eventually the commodities are going to start to react to all this currency debasement, and they're not going to keep going lower than or stay in a trading range.
Well, some already have. So starting about 6 months ago, my whole stump speech, every time I would give a speech at a private event, I would say Bitcoin, gold, silver, real estate, and copper. But copper hasn't, I want copper over 400 before I start to really increase my position in it. But the things like the softer commodities, like the food stuff, like corn and wheat and beans, that got cratered just because of a couple great growing seasons in a row. I just spoke at an agriculture conference a couple of weeks ago, and the people were just too good at their jobs over the last couple of years and driven the price down. Now, that being said, the $4 a bushel level in corn to me looks like a very good buy. I'm not long at it all, but I'm actually thinking about it because I do believe, if you believe what I do, and that is, so can I have 3 minutes to describe what I think is my base case for the next 6 months?
Go for it. We have it. We have an hour here. I mean, or over an hour. Whatever you want, man. I'm enjoying this. My listeners want to hear about. We don't have many agriculture experts on, so this is great.
I'm switching back to regular hard finance here because this is my base case over the next 6 months. Have you noticed that the Treasury, in order to finance their wild, crazy spending, have been issuing a lot more short-dated bonds than they have been long-dated? Now, there's two reasons for that. The most important one is that there was $2.2 trillion in the reverse repo system. Now, anyone who's listening to this, you don't need to know what reverse repo is. We could go into a whole half-hour thing on that. We don't need to. So let's just look at it this way. There was $2.2 trillion that banks held on their balance sheet. Let's call them deposits because that was some of them that were looking for treasuries to be swapped into, because if a bank just has a deposit, it's just dead money. They need to swap it into something. So the Treasury, who issues the bonds to raise money for the government to spend, noticed that money was out there. So they started just to sell shorter end bonds, and they've really, really twisted towards short end bonds at the expense of selling long end bonds. Every time over the last 3 months, except for twice, every time they've tried to sell bonds over like 7 years, the auction hasn't gone very well. The demand isn't there that they thought it was. So they quickly get scared and go back to the reverse repo and sell three-month bills. So anyway, so that money in the reverse repo since May has gone from 2.2 trillion to 500 billion. And if it stays on the trajectory it's at, it will run out in June. So at June, and several Fed speakers have commented on this, saying, well, things are a little bit less certain once we bleed dry the reverse repo facility, and then we actually have to go to the open market to sell bonds, and we have to choose our durations across the curve. So does this make sense so far?
Yeah, and to add to your points there, I mean, didn't Biden, when he took over in the White House, he drained the Treasury general account because Trump had it up. It was at a really, really high level. Now it drained. It was down to a couple $100 billion. It was a couple $1 trillion, I think, almost $2 trillion at one point. It was down to a couple $100 billion within a very short amount of time once Biden came into the White House. And then I think the Federal Reserve Bank, because where interest rates where they are, and they're paying out a lot of interest payments to the banks parking cash at the old QE programs and interest on excess reserves. I mean, the Fed is I would say if they were using generally accepted accounting principles, the Federal Reserve Bank is insolvent, but they don't have to use GAAP accounting. And they're not giving the Treasury Department those $80 billion per year in bond profits that the Treasury Department is used to. They're not reminiscing profits. The Fed's running at losses now.
Good. I knew you knew this shit. I just didn't know you knew it to that level. I'm so glad you do. That's excellent. So now back to the Treasury General account, because that's the buffer that nobody's really talking about. Now you and I will, because I believe that's at about 700 billion right now. Does that sound about right to you?
I haven't looked at the new number in a while. Wouldn't surprise me if they tapped it back up. I mean, they play so many games. They should have, I mean, logically, they should have termed out the debt a long time ago, 30 years, and they should have ran it like an emerging market and started inflating the debt away. But for some reason, they didn't do that.
Well, there's a mild reason why they didn't do it, because the global demand for short-term U.S. Treasury reserves. I mean, if you're going to be the reserve currency, you do have to, flood's the wrong word, but you have to supply the world with the short-term treasuries it demands. But yes, to your point, everybody else took advantage of interest rates where they were zeroed out essentially across the curve and rolled into duration. The U.S. Treasury was the only people who did not. But back to the Treasury General Account. Let's say it's 700 billion. If I'm wrong, I'm not wrong by much. Maybe 100 billion in either direction. Which is actually, that's such a government thing. Like, what's 100 billion between friends? Anyway, back to the point.
That's so like 2 months.
Right, exactly. So they run out the reverse repo sometime. I'm estimating May or June. And then they have a couple options. One, they just go straight to the open market to sell bonds and see what happens. Or two, they start draining the Treasury General Account. Janet Yellen likes to have that account. So I think they're going to be reluctant to drain that, but it does exist as a buffer. But my point is that they've used the word uncertain about what the actual demand is for long-term U.S. Treasuries, and we're going to find out. And my point, like, it might go well, and it might not go well. But why in the hell would we ever have put ourselves in a position where we are uncertain about how easy it's going to be to sell longer term U.S. Treasuries, because there's just too damn many U.S. Treasuries to be sold? So here's what I assume is going to happen. I assume they're going to start selling long end bonds. And if they continue spending money like drunken sailors, which I keep trying to think of a better metaphor, because it's such a beat up metaphor, but it's still very applicable here. They still keep spending money like drunken sailors, the federal government, and all of a sudden they have a difficult time raising that money through long end auctions. I think the Fed will flip so quickly from QT to QE that it'll make your head spin. And I can back that up a little bit too. A year ago, March, when SVB and Signature Bank had difficulty, what did they do? They immediately opened the door to that bank term funding program, which essentially was buying bonds at par that were worth about 30% less than par. So they were taking your and my money, Jason, and buying things that weren't worth it. In other words, QE. They were doing QE, and that's why their balance sheet bumped up. But anyway, so I think sometime later this year, the Fed then will flip on a dime, start buying bonds to support the Treasury's drunken sailor spending habit. And at that point in time, the trades that I've loved up to this time, I'm going to love even more. And again, it's funny is that, when I started giving my speeches Bitcoin, I started getting long a full year ago, because when BlackRock started expanding to Bitcoin, that was good enough for me. So I started getting long Bitcoin. But 6 months ago, the whole thing was, gold, silver, Bitcoin, real estate. Those things have been doing fantastic. You saw gold today. Gold broke out of its range today and looks headed higher. Oh, you sent me that it broke out of its range. I wasn't even watching. I was busy. But I am quite long it. I think those trades will go from being good to great, is my opinion on that.
Yeah, it looks like Stanley Druckenmiller, with his asset rotation, he's been taking profits on those overvalued technology stocks and rotating into undervalued oil and natural gas companies, space metals, and gold miners. Looks like those trades are going to pay off in the not too distant future. The gold price did have a big pop today, over $40 pop on Friday, March 1st, 2024, like Jim was alluding to. We're almost to $2,100. Nice big pop. But the Bitcoin rally, I would say lately, Jim, I think a lot of it is flight capital. I think there's immense problems with the global economy in Europe, China. So those countries are definitely already in a recession. So there's a lot of flight capital that's leaving those countries, especially China. And Bitcoin is one of the ways to get around those capital controls.
I like that. And I hadn't really considered it, because I'm going to add that to my belief in Bitcoin, because I thought a couple things. I thought a lot of it reflected the extra $2.5 trillion that's in the system that I alluded to before, coupled with, so it's like a quasi risk on, and half of it is a mistrust of the stewards of our fiat currencies. And I was looking at it through a domestic lens, but I really like what you're doing, it broadening it out globally. So then you add a couple things we've talked about before. Now the Bitcoin world knows that the bank term funding program is supposedly going to run out this month, and they're going to close it up. Bullshit. By the way, is it okay if I swear on your podcast? I'm sorry about that.
Yes, that's fine. That's fine.
Okay, good. Okay, bullshit.
Very politically incorrect.
Good. As soon as banks start to show any fissures at all again, they will open that thing up quickly, which will have the same effect of weakening the dollar. The Bitcoin market knows that there's still problems in the banking world. They know that a reverse repo is going to run out in May or June. And they also know that about the halving, the Bitcoin halving, which is, for your listeners who don't know, I'm sure most of them do. The point of it is that it's going to become half as worthwhile to mine Bitcoin. So the thesis is that there'll be less mining of Bitcoin, making it more scarce. Now, all this, when I even talk about Bitcoin, it sounds crazy to me because I barely even believe in the whole thesis, but I don't care because I think that so many people believe in the thesis that I'm planning on speculating on and making money. And so far, that's been a good trade. Like, are you a crazy Bitcoin holder? Do you believe in the whole Bitcoin solves this crap or no?
No, I have read the Satoshi Whitepaper, and I've been covering Bitcoin. Actually, I know Trace Meyer, who was one of the early investors in Bitcoin. So I've known him since like 2010 or 11 before he even bought a Bitcoin. So he was trying to explain to me, and I didn't understand all the stuff. I don't have a tech background, though. So I did read the Satoshi Whitepaper, and Bitcoin is what meant to act as digital gold, and the halving, as you described, it's meant to act like gold mining. So for our listeners out there, gold mining becomes very, very difficult as time goes on, becomes more expensive to mine gold. So the Bitcoin halving process is meant to do that with the miners verifying the transactions.
Right. Exactly. Good. And so, yeah, so that could all line up to be another tailwind for Bitcoin. And again, I don't have to fully understand or even fully believe in the theses I trade on. I just have to believe that other people will. And even like the dollar thing, when I'm talking about the Fed coming back into QE, I think it's going to punch it out. Do I think there's going to be a currency crisis in this country? I don't. And if there is, I don't think it's within the next 20 years. I think that there are other currencies in this world, like it's just the world's tallest midget thesis. What's going to replace the dollar right now? Which, by the way, it's not a good thing. I think that cockiness is causing this level of hubris within our Federal Reserve that they're like, whatever, we can do whatever we want. And our Treasury, nobody's going to abandon the dollar. And they're right up until the point that they're wrong. And I don't perceive them on.
They did shoot themselves in the foot like Yosemite Sam in the Looney Tunes commercial, in the Looney Tunes, cartoons with the sanctions on Russia, because they did try to weaponize the dollar and all the sanctions, and they were threatening to steal, what, 300 billion in treasuries. I don't know if they've fully taken all the treasuries yet, but all the other countries outside the G7 saw the writing on the wall and said, we're not going to buy a lot of treasuries anymore. So it backfired on them tremendously. And gold demand from central banks non-G7 has spiked a lot since then.
Right. And gold demand, that's one of the reasons I was long gold too. One of my theses was that global central banks were buying gold at a rate that we haven't seen in 75 years. And what we did when we froze Russia out of the SWIFT payment system and froze all their assets, that's appalling. The world puts us as the reserve currency, which means we are the ones who are the arbiters of the global disputes. Now, the reason that nobody would trust China to do that is because nobody trusts China. So they're not a acceptable alternative, obviously. But everything we do like that, and I don't know if you noticed, but just this week, there's more talk about seizing more Russian assets. And they do it. It's such a populist bullshit thing because they expect the people who fly the Ukrainian flags on their Twitter page to go, yeah, freeze up Russian assets. No, that's not the way it's supposed to work. We are supposed to be above many of the skirmishes that go on because that's part of being the world's reserve currency. We are not at war with Russia, last I checked, although it seems like they are like walking us to it where they almost want people to believe that we're at war with Russia. But last I checked, we're not.
But it's creating a supply-demand mismatch problem in the treasury market because the normal buyers for the last few decades, so China, Germany, Russia, the large countries that run enormous trade surpluses that would recycle their foreign exchange reserves, trade surpluses into U.S. treasuries, they're not buying. And yet DC, the spending here, both political parties, the White House, it honestly doesn't really matter which party's in charge because they're kind of just rearranging deck chairs on the Titanic. They're just fighting over where to spend the money. None of the 535 members of Congress, really very few, are actually wanting to do significant spending cuts. They're really just arguing about where to spend the money.
Not just are they not. I was laughing the whole time we were saying that. Sometimes I wish we were on video. I was on Charles Payne's show today on Fox, and I said, sure, Republicans love to talk about spending cuts, but only when they're not in a position to do anything about it, because as soon as they get in the position, they hit the gas pedal just like the Democrats do. So it's terrible that these are our two choices. But to your point, yes, we're increasing our spending. The world is not as interested in buying our bonds as it used to be. There is still a demand for our bonds. I am not saying the sky is falling now. I am saying we're putting a lot of pressure on that sky, and at some point in time, we could worry about pieces falling down. But yes, to your point, if all those countries have less of an appetite for U.S. treasuries, and we have to sell more of them after the reverse repo facility runs out, well, what's going to happen? The Treasury is going to buy them, and it's going to weaken the dollar. So I'd be long stuff.
So the Fed's balance sheet, you would say in the next 6, 12, 18 months, it's going to have to expand for either bond purchases for US Treasury debt or the commercial real estate crisis, because let's be honest here. I mean, the Fed's job is to save the banking system. So if the banking system, whether that's the regional banks or some of the larger banks, they get in trouble with some of these office buildings and others, the Fed's not going to let all the banks fail. The Fed's going to create more of those liquidity programs, probably way larger than the BTFP. I mean, I've heard rumors that they're even talking already, because they know the losses are going to be hundreds of billions. They're even talking about a third government-sponsored enterprise like Fannie Mae or Freddie Mac to start sticking the stuff in there.
Yeah. This, like, the smile's gone from my face now, because I go back to last March. It literally took them about 2 days before they came up with the bank term funding program and started buying those bonds and spending yours and my money on these failed idiotic banks who, by the way, I could have easily hedged their bond risk. It's kind of what I do. It would have been a 10-minute phone call to hedge their 10-year portfolio. That's what they lost money on. But to your point, I think the Fed has already shown us that they will flip on a dime to save the banking system. As you said, the Fed is not here really for us. The Fed is here for the banking system, and they've proven that since 1913. I assume you've read Creature from Jekyll Island. That book gives me goosebumps when I read it.
Oh, I know more about the Silicon Valley Bank story. Actually, Jerome Powell and Janet Yellen, they actually hate each other now, because Jerome Powell actually wanted the bank to fail. And Janet Yellen, because she got political pressure, because there was so much money from all the rich people in Silicon Valley and Hollywood. All the Democrats had way over FDIC limits at Silicon Valley Bank. I mean, the Oscar-winning actress Sharon Stone gave a speech. She said she had half her life savings at Silicon Valley Bank. So there was enormous pressure there for the rules to change, with the FDIC limits and the liquidity programs to step in.
So listen, all the people who are listening to this, we'd like to thank you very much. So, because your hard-earned tax dollars went to bail out Sharon Stone and the rich elite, because they're too moronic to run a bank properly. And Silicon Valley Bank, like, the CEO was on these, DEI boards and things like that. And instead of actually looking at what you're holding in your hold to maturity portfolio, you're worried about all this bullshit stuff. The whole thing is ridiculous. Like, everything we uncover here that we're talking about everything is so self-inflicted. You already once mentioned shooting yourself in the foot. Was it Yosemite Sam? He said he shot himself in the foot.
Well, that's the Looney Tunes show.
The Looney Tunes, right? By the way, your voice sounds too young to know Looney Tunes. We'll talk about that later, though. But all these things could have been avoided, should have been avoided. Janet Yellen went in and said, yeah, we're saving these banks. But in the future, if you're not a systemically important bank, we won't. To that, I say, that's not true. They will. You know what I know that it's such an awful thing? Because there's even, like, when Silicon Valley Bank started to fail, and when Signature Bank started to fail, to me, it brings back 2007, which was a terrifying time for me. I had a ton of real estate at the time. And I remember there was moments where they'd say, okay, we're going to step in and save these. And I would say, oh, thank God. And then I remember 5 minutes later, no, this is not good long term. You're a capitalist. I've studied these things. You are supposed to let things happen, laissez-faire in the financial markets, and that's how you get a stronger financial market going forward. But we didn't do any of those things. But anyway, if me, and I don't know about you, but if me sometimes has that slip where I say, oh, this is fine, the rest of the country is of course going to be signed up for that. Like, oh, wait, we can not have any bank failures, but they don't understand the ramifications. And I fully believe, and I wrote about this a bunch, in 20 years' time, I think there's going to be about 20 total banks in this country. And I think it's going to be much more nationalist as far as the banking system goes. And again, I don't think that anyone's even going to be that surprised. We live in a corporatist world where the government is so involved with corporations. Why wouldn't we think that they're eventually going to take over the banking system? Spoiler alert, they will.
I would love more free markets, more free market capitalism and deflation. I just don't think in the current system that we have, it's going to be allowed. There's, especially with the derivatives markets, because like you said, you expected bankruptcies and deflation. Well, the problem is Bear Stearns fails, Lehman Brothers fails, and all their counterparties in the derivatives markets, all the other banks that they have loans outstanding to, it starts to fall like dominoes. This is the problem with the debt-based fiat currency and fractional reserve banking and derivative system that we have, that it's way over leveraged. If the banks were not doing like all these derivative trades and fractional reserve banking, we could allow banks to fail. One or two banks, large banks failing would not collapse the system. But when the system is that over leveraged, I think at one point in 2008, Citibank was leveraged at 100 to 1, and the Fed lowered the reserve requirement ratios down to 0 to save Citibank's equity, so Citibank didn't fail too.
Right. And, Rick Santelli and I used to have massive fights with this because I actually was for bailing out the banks back then. And my reasoning was this, is that it wasn't just like this open competitive market that was falling. It was literally the government had spent the 20 previous years leading every bank to the cliff. Just the existence of Fannie and Freddie in the market, buying all those mortgage backs, government entities providing a floor for that, encouraging the same trade so that every bank had on the same trade, like you said, leveraged out the ass. And all of a sudden, the shit hits the fan. I think it would have been an awful time for the government to walk you to the cliff, move you over the cliff, and then all of a sudden pull their hands back and say, oh yeah, everyone's on their own. So I was for the bank bailouts. Now, in retrospect, it really did kind of open the door for moral hazard for a bailout society. But I fully believe we're in a bailout society now. On Sunday night, I'm doing a show at a local Illinois radio station about the state of Illinois and why Illinois bonds, why anyone lends money to Illinois. And you know what I'm going to say just from this conversation? I'm going to say that there is an implicit federal backstop for Illinois bonds, in my opinion. Like, nobody says it out loud, but everybody knows that the second Illinois really runs out of money, they're going to funnel a bunch more federal money to them. They've done it in the past. They'll do it again.
Well, you and me don't get votes on bailouts or allowing bankruptcy or deflation. So for a small business owner, we're probably not going to get a bailout unless there's some type of program like during the pandemic that we qualify for. It's the bank lobbyists. It's all the industry trade group people that are here in DC. It's a revolving door of corruption between Wall Street, DC, large corporations that decide who gets bailouts and what. Because unfortunately, and I've lived here in the Washington, DC metro area for almost 25 years, I used to drink with bank lobbyists. Many years ago, I don't drink as much and go out to the parties and the charity events. But I mean, these guys, like, they know a lot of these politicians, both political parties now. I mean, I see ones that go on business television on MSNBC and CNN and talk about how they hate capitalism and billionaires. Those are the ones that at the parties, all they talk about is all the money they're making, how good their stock trades are doing, their real estate, all their expensive luxury travel, their designer goods. I mean, like, it's the levels of hypocrisy here are at Roman Empire levels or Versailles in Paris before the French Revolution. The levels of corruption and hypocrisy are that bad. Most of Congress, Jim, cares mostly about stock trades at this point and how much extra they can make on side deals.
By the way, none of this surprises me one bit. I do think we're at late stage shit, and I think that something's got to change and change relatively quickly to shake us out of this, because I think we're heading down an awful path. And like you said about Congress making trades, like and I'm sure you know this because I wrote about it. It was like 4 months ago that I piggybacked Nancy Pelosi. I did it mostly as a joke in that stock, just to say that I was. And then all of a sudden, I'm like, oh, Jesus Christ, look at how much money I made in this. And like, I just, it was more of a lark than anything else. I bought, a couple handfuls of shares, and all of a sudden I made 10 grand from Nancy Pelosi. I'm like, holy cow. But the point is that, yeah, we're in a weird spot. But as investors and traders, we have to figure out how to position ourselves for, first, to avoid the most possible pain, and secondly, how to actually profit for it. And, I know we've said a bunch of those things before about gold and Bitcoin, but I can't stress it enough.
And this is why I don't think the people in DC, the Federal Reserve Bank, will allow asset prices to stay low, because the more government spends, the more some of these stocks can go up on pump and dump. Look at the electric vehicle companies. Other than Tesla Motors, some of these electric vehicle companies, they went up enormously. Now they're going to end up filing bankruptcy a few years later. But there was a big pump and dump that was sponsored by the government. The government spent a lot of money and gave some of these solar, wind, electric vehicle companies a lot of subsidies. The shares went up. The insiders cashed out. They made their profits. They got their extra wealth. And now the retail investor is getting stuck with the bag.
Sure. And it's not just the small EV manufacturers. They gave Ford $9 billion. They call it a loan, but they're not getting paid back that loan, because Ford eventually is going to realize what the others realize too, is that there's not the right amount of demand for EV. The technology is not perfect. I live in a cold area here. It's not good for EVs. So that's the whole corporatist thing. That's a problem. But at the end of the day, what we're saying, I think, what I'm saying for sure, is that when they are forced, whether the economy goes to hell or the dollar goes to hell, they will choose sending the dollar to hell. And at that point in time, we need to have diversified our dollars into stuff that's going to go up. And by the way, I think the US stock market is part of that equation. I think it could do very, very well. I do think within the next 3 or 4 months, when the things start to hit the fan, I do think the stock market's going to have a 10 to 12% pretty swift correction. I'm positioned for that in options. Cheap options they're giving away. Volatility is so low. Even today, I was doing 1x3 put spreads where I would sell a closer to the market put to buy 3 puts underneath it at several of the indexes, because I think there's going to be a quick 10% pullback, because the stock, that's what generally happens when you go from a tightening cycle to an easing cycle, is that they keep saying, we're not going to ease, we're not going to ease, we're not going to ease. And all of a sudden, everything hits the fan all at once. Like, yeah, not only are we going to ease, we're going to ease really fast. And that's what I think will happen. They have showed us in the past that they will choose to save, I'm doing quotation marks for save the economy at the risk of the dollar.
Well, I think it's all about tax receipts at this point, because U.S. federal government finances have changed so much the last couple of decades. They've become increasingly reliant on capital gains taxes from stocks, bonds, real estate, and people trading. That basically, if the stock market stayed low and crashed for, say, 6 months or longer, I mean, there would be a tax receipt issue for the U.S. federal government. And then also, if home prices crash, there'd be issues for property taxes at the state and local level. Normally, what the Fed has done in 2008 and again in 2020, that was one of the real reasons for quantitative easing and balance sheet expansion. The Fed had to fill that gap in tax receipts.
Yep. And by the way, there was a time where you would have said something like that and people looked at you like you were from Mars. And now people are like, yeah, no, that makes perfect sense. And of course it is right there. Which, by the way, the capital gains tax things is so funny. Like right now, for rich people, it's at 23%. They know full well, and they've admitted it publicly, both parties, that lowering that tax would increase receipts from it, because I sell nothing. The mantra of like the I hate calling myself the rich people, but like whatever. The mantra of the rich people, let's say I'm not talking about myself, is never sell anything, never pay the tax. Like even like a week ago, I bought a biotech stock that went through the roof, and it was in a taxable account. And I'm like, oh crap, what do I do? Well, I'm not selling it ever. I just collared it, sold some calls, bought some puts. I mean, I'm in front of trading screens every day. I have the option to be able I have the option to be able to do that. So because I don't want to pay taxes. I don't want to pay short-term gains. I don't want to pay long-term gains. You don't sell.
So I want to transition now to the restaurant industry.
Good.
For our listeners out there, Jim actually owns a famous restaurant in the Chicago area. It's a burger restaurant. So talk about your restaurant, and then I'll ask you questions about the restaurant industry.
Okay, so my restaurant opened up where it is in 1931 to be a speakeasy during Prohibition by a gangster by the name of Roger Toohey, who came out to the northwest suburbs to brew beer. And it's an old farmhouse with this rich gangster history. He feuded with Al Capone. I actually wrote a story about it that's about a 15-minute read. Like even the war between Roger Toohey, the gangster who owned my restaurant, and Al Capone's gang raged for 3 years, and it involved dozens of deaths, including a hit on the Chicago mayor, Anton Cermak, who had switched his allegiance from Al Capone's group to Roger Toohey's group, my guy. And so they hit him in Florida when he was at an FDR campaign event. So there was just dozens and dozens dead. And the history is amazing. And we bought it 11 years ago last month. And Buddy and I have been going there since the 70s. I'm from this area. And we restored it. And now it does wildly well. And to call it a burger joint is, 60% of what we sell is a burger, but it's not. It is, it's a $18, $20 burger, big pile of fries, homemade coleslaw, huge burger. It's a high-end pub food. And our ribs, about 25% of what we sell are our ribs. We win awards for them. We have a line out the door all the time. But I'm sure you want to talk about the finances of it too, because that's changed.
Well, actually, it's around dinner time. I'm getting hungry.
Me too. I'm going there as soon as we're done. We'll call this about 10 minutes. I'm going to jump in the shower and head over there and flirt with the old ladies in the dinner crowd. We get a lot. All you have to do in the restaurant business is serve really good food and have fun with people. It is a gas. I'll go in there for the next 45 minutes after I'm done with you, and I'll walk table to table, tell some jokes with people, have a drink with somebody. People just want to feel welcome in a place. It's a crazy world. Like we've underscored a million times in this conversation. People love to go to a place where time stands still. You think you're in 1931 when you walk into this place, and people love it. Old people love it. And I'll go there for an hour. My wife will pick me up. We'll go out to dinner, meet our friends. That's a normal Friday night for us, and I love it. Wouldn't change a thing.
That sounds like fun. Speakeasy concept, and then you have good burgers and ribs and stuff like that. Sounds like a good concept that you can set up a franchise model for if you're interested in expanding it. We were talking about that before I start. I don't want to put pressure on you, but there are opportunities here in the DC metro area. Anyways, though, I want to ask you about the economics, the finances for the restaurant industry. So we were talking earlier in the interview about the wholesale food prices. We're seeing all these headlines about like California and other states that want to raise minimum wages, I think $22 or higher. For a restaurant owner, how are your costs dealing with when the narrative now is that inflation is coming out? Are any of your costs actually substantially coming down?
Oh no, our costs have gone through the roof. To put it in perspective, 10 years ago, we bought 11 years ago. We had to buy all new appliances. The place was a shithole, run into disrepair. So we bought a cooktop for $6,000, beautiful cooktop for the kitchen, which we have 2 of them. That just went on the fritz about 6 months ago. We bought one 3 months ago, the same exact cooktop for $22,000 in 11 years time. $6,000 to $22,000, just to underscore that. And that's not even, that's the half of it because a restaurant has much more input costs. Everyone just thinks food, but it's equipment, it's energy, it's labor. Labor's gone through the roof. Now Illinois is kicking around, because our waitresses make a ton. They make probably $50-$60 an hour easily every dinner shift. But minimum wage, the minimum wage we guarantee is $5. They're fine with that, by the way. But now the state wants to raise that to $15, have no tipped exemption. So what we'll do, and what's happened in some places in California, which is it always works the opposite way the government pretends to want it. What some places in California have done when they've raised tipped wages to $20 is that they tell their waitresses, no, we're going to pay you $35 an hour. However, tipping is done at this restaurant. There'll be an 18% surcharge on every meal that will say to go into employee tip pool, et cetera. So then it'll be at the owner's discretion to dole out money. And guess what's going to happen? The owners are going to end up making more money. So that part, I'm not that scared about. I think that if they want to do just the colossally stupid things and raise those prices up to there, that's fine. But now back to our restaurant. So let's say, and these numbers are kind of, very, very thumbnail. But let's say before 2.5 years ago, we needed the minimum of $50,000 of sales just to cover our expenses in a week. So every week we needed to sell $50,000 of product, and we haven't made a penny yet. And it's only above that we start making money. Well, that number has jumped 50%. So now it's $75,000 in just 2.5 years' time before we make a penny. So we are faced with decisions. So a bunch of our friends in the business are already closing their doors in mom and pop business. And I think in these big, what's the color for the Democrats say? Is that blue states? Blue states. In these big blue states like Illinois, I don't think they give a shit about the small mom and pops going out of business. I think they learned in 2020 that the small mom and pops restaurants and the independently owned restaurants were much more difficult to control than the big chains. I think they'd prefer to have a bunch of big chains. So they keep leaning on these restaurants. I think we'll do fine because I think in the end of the day, what happens is a bunch of our competition will go out of business and leave us to be one of the few options in our class of restaurants. So we're going to be fine, which is not what I wanted, by the way. I want it to be an open. I'm complaining to our village that there's a guy trying to open an Italian restaurant in town, and they're putting up hurdles for him to open it that are a mile high. I've heard stories, and I'm going to talk to these people I know in the village. I want him to be able to open his restaurant. It is unfair to keep these people out of it. But anyway, our expenses have gone through the roof and went from being a great business to a pretty good business. And what we've decided to do is we've raised our prices probably 20%. Probably some of the restaurants you go to, my guess would be they've raised it 35% to 40% over the last 3 years. Is that a pretty accurate assessment?
Yeah, plus there's shrinkflation, and it's difficult. So for shrinkflation, there's either substitution of quality. So normally it's with meat items or quality of vegetables, or portion sizes are going down. So it's a combination of price hikes and shrinkflation.
Yeah. So, right. So we've decided, and again, me and my partner was the CIO of Motorola. I live in Motorola country out here in the northwest suburbs of Palatine. And, again, my point is that we didn't scrape together every last dollar we had to open our dream restaurant. We were in a little different position. So we've decided now to basically tread water ourselves for the next year or two to make sure we don't shock our customers with huge price increases. But then as the years wear on, we will try to get our prices back to a level where it becomes a good and viable business. And like I said, it's still an okay business. We're still making money, but it's nothing like it was 2.5 years ago. And these people who are mortgages and people who don't have the level of pockets that we do are going to have a very, very difficult time.
Well, let me tell you, as a customer, and this kind of pisses me off because we're not given the option at a lot of places where the price increases and then the portion size drops drastically. I mean, I'd rather just pay more money to get like the same portion, maybe offer people to either survey your customers or give them an option or something like that. Because like the restaurant owners are just deciding for the customer that we're going to drastically reduce the portion size of the meat. And I eat mostly keto. I don't eat a lot of carbs, or occasionally I have a cheat day a couple days a week. So I fill up better if I have meat and vegetables. I'd rather pay more money so I have like a good piece of chicken or steak or pork ribs. I'm sure yours are excellent. So I'd rather pay more money for my protein and vegetables so I eat relatively healthier than get screwed over with smaller portion size at a higher price.
And made up for a pile of French fries that cost us next to nothing. I agree with you 100%. And that's why we're trying to keep everything consistent, to not try to shock people with silly things like you're describing, and just try to make less money ourselves. And hopefully this thing rights itself. I think it will. One of the reasons I got in the restaurant business too is that with the decline of the shopping center, and I know our shopping centers around here during Christmas were actually very crowded, but with people shopping online, there needs to be places that are social places for people to go and to hang out. And that's why I think the local tavern restaurant is invaluable to people, particularly older people who need to connect. And so we're not going to change things too much for the reasons you described. We're just going to try to ride the storm out.
So you think going forward, then more shrinkflation, more substitution, higher input costs. I mean, there's not much you can do to mitigate those risks or kind of lock in prices or anything. You think that a lot of it's like currency debasement and in policy decisions from politicians and bureaucrats then?
Oh, no question, particularly in states like Illinois. And I think much of it comes from bureaucrats and policy decisions. We always joke like our state and our county, when we started dealing with them 10 years ago, we realized they don't give a shit if they put us out of business. They don't give a shit if they put everybody out of business. They'll just then shrug their shoulders and go, I wonder why our revenues have fallen off a cliff. I don't think, and it's not even that they're too stupid to understand. They just don't care. They'll just go get another job, I think they think. So yes, I think the policy decisions are ridiculous. I do expect to see a lot more of shrinkflation and substitution for lower quality, but more importantly than that, I expect to see a lot more foreclosures and bankruptcies in the restaurant world, particularly in the independents.
And the chain restaurants are closing amount of locations like crazy too. So the publicly traded companies, I mean, some of these chain restaurants waste tons and tons of funds. They have like 50-page books for menus that a small business owner like yourself could never get away with. And so they're wasting tons of shareholder funds, but they're closing locations like crazy. So this is hurting them too.
No doubt. But I was under the impression, correct me if I'm wrong, that most of those stories I read about closing tons of fast food locations are in urban centers that have decayed rather quickly. Is that your understanding as well?
I think it's the sit down places. So like the middle class sit down places, kind of like Italian restaurants that are competing with Olive Garden. So those types of chains like a BJ's Brew House and some of the Outback Steakhouse, I think just closed 50 locations. Outback has been Outback was mismanaged way before the pandemic. I mean, they were shrinkflating like crazy on the steak portion and raising the menu prices. So I would have rather just paid a higher price for the same size steak. Instead, the management just decided that they were going to raise the price and reduce the steak and the quality.
Right. Well, I proudly, aside from investing and looking at charts, I proudly don't know much about the chain restaurant business because I'm disgusted by the chain restaurant business, and I almost never eat at chains. I don't never eat at chains. I sometimes do, but I try to stay away from it. But I'm interested in that. I'll do a lot more research on that because I did not know that was the case. Hey, are we going to be able to wrap up relatively soon? I do got to get to work.
Yeah. I was just saying that I used to cover some of these stocks. So, I mean, I'd look at the waste on the financial statements for some of these companies with the shareholder funds. And then you go eat at the restaurant and you see the menu is literally pages and pages and pages. Like a small business owner like yourself, they're going to manage their inventory way better. They're not going to stuff that doesn't sell. They're going to take it off the menu. And they're not going to run a large book for a menu like a Cheesecake Factory.
Yes. Which, by the way, when I go to a place like the Cheesecake Factory or any place that has a huge menu, I always wonder how many things do they think they can do good. So that's a turn off to me right away. But we are forgetting that they have economies of scale on the other side of that too. Lets them buy food cheaper, things like that. But yes, to your point, when something becomes a big bureaucratic mess, guess what? Yeah, it's not run nearly as well. That's what I always joke about with people with the chain restaurants is that, they're soulless. The soul at an independent place, you feel everything. You feel the price increase in lettuce. At the big chain places, there's so many layers of people that they barely do.
Well, plus they're not using their own money. They're using shareholder funds. A lot of them are private equity money because it's like a Series C round of private equity money, and they're planning on going IPO and dumping it onto retail investors.
Excellent point. So you're suggesting, and this kind of circles us back to government, when you're negotiating with other people's money, you don't care about it as much. I think that's probably the point. That's one of the takeaways of this show.
Well, I really enjoyed our discussion today, Jim. We definitely have to have you back on. Your insights in the restaurant industry are great. And unfortunately, I think we're going to see a lot more currency debasement going forward. And it's not just going to be from the US government. It's going to be from all these governments. I think they're all trying to debase their currency.
I believe that too, and it scares the hell out of me. So hopefully we'll talk again soon, and hopefully we'll say we were wrong, but I don't think that's going to be the case.
No, I think they're going to keep doing it. They may take breaks here or there, but I think that's the plan. They want to devalue the debt so they can keep spending.
Keep spending. Amen, brother.
So if my listeners want to follow you on Twitter or take a look at your new podcast, how do they do so?
So my Twitter, it's at Jim Iuorio, JIMIUORIO. One of the podcasts is called The Future's Edge. That one's about 60 to 70% like hard finance and 30 to 40% like different pop culture things. We've had, the president of the Heritage Foundation, Vivek Ramaswamy. We've had a guy who sells cold plunge tubs. And hopefully people find that interesting. The other one is called The Trader's Edge through Tradier, which is the brokerage house that sponsors it and owns it. And that one's almost strictly trading, finance, and economics. So The Future's Edge and The Trader's Edge.